Welcome to Looking at the Markets with David Modell. I want to talk about a triple moving average strategy, and this involves three moving averages and specifically three EMAs, exponential moving averages. Now you can try this out with SMAs or simple moving averages if you prefer, but for this one I like the EMAs, the exponential moving averages, a little bit better, just my personal preference because they are more reactive, meaning they react quicker, the EMAs. They react faster to the price action compared to SMAs or simple moving averages usually, all right? Now with any new strategy you're trying out, do not test it out with real money. Test it out with virtual or demo trading where you're not using real money to make sure it works for you before you even think about using any actual money at all right? And always have an exit strategy and be prepared to take a loss because there's no guarantee. No guarantee that this will make money. You could lose money. Be aware of that. Okay. So I'm using tradingview.com. I want to give them credit. And I went to the indicators and I typed in EMA. Okay, it came up with moving average exponential. And I clicked on it 3 times to get 3 lines. All right. And then I made them 3 different colors and I set them for 3 different periods. Okay, 3 different look back periods. The 10, you got the 10 period EMA. The 30 period EMA and the 100 period EMA. Okay. And by the way, I'm using Apple stock in the daily candlestick chart. Each candlestick represents 1 day of price action, but you're welcome to try this out with virtual or demo trading, no real money, with different time frames. You could try it with 1 minute candles, 5 minute candles, hourly, whatever you prefer, because the lines typically will adjust to the time frame. Okay. So I'm looking at Apple stock and I'm thinking about when should I go long? When should I buy? Well, rule number 1 here with this strategy is first look at the 100 period EMA, which is the black line here. It's the slowest one, but probably the most important one. I'm going to call this the line that must not be crossed. Okay. So what that means is that only go long, only buy when or if the candles are above the 100 period EMA, okay? If and when the candles cross below the 100 period EMA, don't be a buyer, okay? And if you were holding the stock, go ahead and sell it. Go ahead and sell your stock or cryptocurrency, whatever it is. Get out, okay? Because if it goes below the line that must not be crossed, don't be a buyer. And if you already were a buyer, get out. Okay, because that's trouble. Because look what can happen. Okay, the candles went below the 100 period EMA, the black line here, and just down and down and down. This could happen. Okay, you don't want to be there. You don't want to be a part of that if you're a buyer. Okay. So does that mean that you automatically buy when the candle closes above? Above the 100 period EMA? No, you're not automatically a buyer. I'm just saying if the candles are below, if it closes below, then you're not a buyer. And if you were a buyer, then sell. Okay. So that's rule number 1. This is the line that must not be crossed. Okay. Yeah, it could cross above, but not below. All right. So that's rule number 1. Rule number 2 for this strategy. And again, there's no guarantee this will work. Okay. Just, make your own decisions, do your own due diligence always. But you're sitting on your hands until a candle closes, not just goes above, but closes above the 100 period EMA. And then you start watching. You're not buying yet. You're just thinking about it. You're watching more closely now. And then wait until the 10 period moving average goes above the 30. It's a crossover strategy here, but with a filter, okay? Yeah, a lot of people use crossover strategies. Maybe you wait until the 10 goes above the 30 and then you buy, okay? But this might happen below the line that must not be crossed. And then you can get yourself into real trouble. Okay, so you've got that filter now. You're not even thinking about doing anything until a candle closes above the 100 period EMA. Okay, then you start watching it, and then if and when the 10 period EMA, the faster line, crosses above the 30 period EMA. Okay, in this case the blue going above the yellow one. Then you can get in. Then you can buy, you could be a buyer and ride it up, however far up it's going to go. And then don't sell until either the 10 goes back below the 30 or a candle closes below the line that must not be crossed, the 100 period EMA. Okay? So there are 2 different ways you can get out. Either when the 10 EMA goes back below the 30 EMA, you get out, you sell. or if one of the candles closes below the 100 period EMA, whichever one happens first. Usually, it'll be the 10 going below the 30. Usually happens first, but not necessarily always. All right. And so this 100 period EMA, it's a nice filter. It keeps you out of the trade when a bear market happens. Okay, when stocks just keep falling and falling and falling. All right. And the 10 and the 30 give you a nice crossover strategy to get you in and out quickly for those quick gains and some losses as well. Be aware that there are going to be some losses with this. Okay, sometimes the 10 is going to go above the 30, and then it'll quickly go back below, and you might take some losses. All right, but you also get to ride out these nice bull markets. Okay, all right. So you got the candles above the 100, right? They're above the 100. Above here, they're above here, but I'm not doing anything yet. I'm just watching, and then look at that, the crossover, and that's when you get in, right? The cross above, the 10 going above the 30, and you ride it all the way up until either the 10 goes back below the 30 here, right? Or one of the candles closes below the 100 period moving average. That gets you out. And it basically, it's almost like a stop loss, okay? It stops losses, but it also helps you to know when to get out and take your profits when something nice like this nice run-up happens. And hopefully it will happen to you, all right? You might have to take, with a lot of crossover strategies, you may have to take a bunch of small losses, but then hopefully maybe you'll make up for it with a nice run-up, a nice rally, okay? So, hope this is helpful to you. I do like the idea of a triple moving average strategy where one of the lines is a filter to keep you out of big trouble sometimes. All right, so if this was helpful to you, please give this video a like and a comment if you want to, and subscribe to my channel if you haven't done that already. I want to thank you for watching and listening. I will talk to you again very soon.